Oil prices have surged past the $100 a barrel mark as the escalating conflict between the U.S., Israel, and Iran raises concern about global supply. For a closer look at the outlook for oil prices and what it means for investors, we're joined by Hussein Allidina of TD Asset Management. Hussein, thanks for taking the time. These are busy times for you. Let's start with this latest movement in oil. What are your initial thoughts?
Yeah, so the market is, I think, trying to determine how much production is lost. Prices are moving higher. The backwardation in the curve, not to get too technical, but the backwardation in the curve is more pronounced than I've ever seen before, and that highlights the scarcity premium associated with the oil market right now. You've seen a tremendous amount of production shut in the inability of tankers to traverse the Straits of Hormuz. This is 20 million barrels a day. It's the largest supply-side disruption we've ever seen in the history of oil, and the market is trying to ration demand. As production is unable to get through the Straits, you're seeing countries like Iraq, like Kuwait. This morning, Saudi has announced that they're also curtailing production. As storage gets full, you have to pull back production. So I think the market is really trying to figure out, how long this goes on for, how meaningful the disruption is, and ultimately how high the price has to go to account for the scarcity.
Let's talk about the fact that obviously prices, the new ritual for me, at least for the past couple of weekends, and you're even more connected to it, is 6 p.m. Eastern time on a Sunday. The future market's open. Pretty wild trading activity. How high could the price go? It's been pretty volatile.
Yeah, so I think ultimately it depends on how sustained the disruption is, or how sustained the closure, the unofficial closure of the Straits is. Ultimately, Greg, the way I think about it is if we're losing supply, if we're not able to get the molecules that we need to, heat our pools, fill up our cars, etc., the price of oil has to move to a level that rations demand. A simple metric that I look at is the oil burden. How much of our income are we spending on energy? Historically, on a global basis, when the oil burden gets to 6, 7, 8, 9, 10%, you start to see demand destruction and weaker economic growth. We were sitting at 3.6% oil burden prior to Israel-U.S. invasion of Iran. Today we're sitting at 6, 6.5. So we're approaching levels where we will start to see demand destruction. To answer your question, though, how high can we go? It really depends on how long this disruption is sustained. When I talk to macro folks, I think a lot of folks refer to, taco, will Trump taco? Even if Trump backs away, we wake up tomorrow morning and there's, peace in the Middle East. When you shut in production, when you take a refinery down, when you shut in LNG facilities, it's not coming back online tomorrow. It's not your espresso machine. This takes 2 to 4 weeks, best case, to see production return to market. And ultimately, the longer this drags on, the more you have to see producers in the Middle East shutter their production, and the more bullish or the more sort of upside there is to price.
Strategic reserves, we know that countries have them around the world. What difference could that make? Is there enough in strategic reserve to start buffeting some of these forces?
So we drew down on strategic reserves in the U.S. in particular in 2022 when Russia invaded Ukraine, and we were concerned about the supply disruption. Just to sort of quantify this, Greg, the supply disruption today is 17 to 20 times larger than the expected supply disruption, which never materialized in 2022. We drew down, President Joe Biden drew down reserves. In the last sort of 16 months, we've rebuilt maybe 70 million barrels of those reserves. It helps. It provides reprieve in the short term if we do see an SPR release. But again, the magnitude of the disruption we're talking about is unprecedented. 20 million barrels a day is not flowing through the Straits of Hormuz in a global market that's 105 million barrels a day. It's great that I have 400 million barrels of crude and storage strategic reserves in the U.S. That's going to help, but it's not going to fix the problem. We have to get the Straits open, and we need to get production flowing again from UAE, from Kuwait, from Iraq, from Iran, from Saudi, if we're not going to see a recession.
Is there any pipeline infrastructure that can help ease that? I saw a headline over the weekend of perhaps some being, sent out to the Red Sea. Is that viable at all?
So you do have some alternatives. So again, 20 million is meant to go through the Straits of Hormuz. It's 21 miles wide at its narrowest. There is something called an east-west pipeline that can take Saudi crude from the east to the west, and then we can flow it through up the Red Sea and go through another pipeline to get into the Mediterranean. That's 5 of 20. There's some pipelines that would take crude to Fujairah in the UAE. The Fujairah port has been hit, so not ideal. Again, there are alternatives that will ease the pain, but ultimately, again, the magnitude of the disruption. If I go back and think about 2011, when we had regime change in Libya, we lost 1.5 million barrels a day of production. The oil price went from $90 a barrel to $120 a barrel. It didn't happen overnight, but as the market appreciated the impact of the supply loss, we saw prices move higher by 30. Today, the magnitude of the disruption, best case scenario is 10 to 12 million barrels a day. With these alternatives, it's not sustainable.
Now, it's not just the oil market that's feeling the pressure of this. We're seeing it across equity markets, so different asset classes. From an investor perspective, what should people be thinking about in terms of maybe just oil exposure in their portfolio?
Well, so when I look at the relative performance of oil, the commodity, versus oil, the equity, we've talked about this before, they're not the same. Energy equities were off last week while the commodity was up. From a portfolio construction point of view, we've argued for a very long time that we want to build a balanced portfolio because we don't have the ability to predict what's going to happen tomorrow. You want to have commodities in your portfolio. You want to have infra in your portfolio. You want to have real estate in your portfolio to have that balanced portfolio. If we're moving into an environment where inflation expectations are going to move higher because of what's happening in energy, my historical 60-40 is not going to work, as was the case in 2020. Yes, there'll be winners and losers within, kind of under the hood, but ultimately you want to have a more balanced portfolio.